Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Few professionals have the depth of perspective on the many market risk events that were missed by models as Rick Bookstaber. Trained at MIT, where he received a PhD in economics, Rick would become Morgan Stanley's first risk manager in 1984. There, and also at Salomon Brothers, Rick was among the quants on Wall Street that developed early pricing models for interest rate derivatives. In this capacity, he had intimate knowledge of the challenges that complex products created for dealers looking to hedge them. And related to this, he also had a front row seat to the early debacles of modern markets, including the crash in 1987 and the LTCM unwind in 1998. Across two excellent books, Demon of Our Own Design and End of Theory, Rick explores the characteristics of markets that make them inherently fragile, including the notion of tight coupling. Here, feedback between trading, price changes, and subsequent trading based on those price changes can give rise to instability. Today, Rick is the founder of Fabric RQ, a firm delivering risk management solutions to the RIA community. Among the issues that Rick worries about today, SPACs, NFTs, and the concentration of richly valued tech stocks and indices like the S&P 500 are among them. I hope you enjoyed this episode of the Alpha Exchange, my discussion with Rick Bookstaber. My guest today on the Alpha Exchange is Rick Bookstaber. He is a prominent risk management executive, has spent years on the sell side, the buy side, on the allocator side, and also in the realm of public policy, having served at the SEC and the Treasury. Rick, thanks for taking the invite, and it's great to have you as a guest today on the podcast.
Well, happy to be able to come on it.
Well, I had mentioned I've been kind of a work-in-progress student of episodes of Financial Crisis. I've read my share of books on these periods and have certainly lived through them. And when I came across your book, Demon of Our Own Design, which was written unbelievably in 2007, highlighting a lot of the fragilities in the system, I wanted to reach out to you because I thought there were so many insights there. You followed it up with a book, End of Theory. So we'll get into it and just really get a chance to understand the world of finance and vulnerability from your career and your academic perspective. As we get our conversation started, tell us about you and your early days. How did you take an interest in our wonderful world of high finance?
Going way back to the beginning, I was in the PhD program in economics at MIT, and a friend of mine said, hey, you ought to try this course that's in this new area called finance, because finance was even considered an actual area of study if you were in economics, and the teacher was Bob Merton, who won a Nobel Prize for the option pricing formula, and I got hooked on finance from his course. So I'm one of the cases where teacher really made the difference in the path of my life. I was in academics, I was teaching, and because I was in option theory and that became a very hot area, I ended up moving into Wall Street. So starting from 1985, I was in Wall Street, starting at Morgan Stanley, then Salomon, and moved fairly quickly from the derivative area into risk management because by the early 1990s, risk management became a key issue.
Well, as you outlined in your book, Demon of Our Own Design, you spent some time reflecting on the 87 crash. And of course, it's a long time ago, but it's just such a seismic event in markets. And one of the things you wrote about in End of Theory is just comparing in some ways the 87 crash to the flash crash of 2010. Which I thought was pretty interesting. Of course, that's not that long ago, but also just a giant move down in stock prices, kind of a liquidity vacuum. I'm curious if maybe we can start there, just kind of comparing these two events very far away from each other in terms of years, but from your perspective, having some similarity in terms of what motivated them and caused them.
Well, and I would add another one to them that we managed to sidestep so quickly that people don't really recognize what happened, which is the market meltdown that occurred in March 2020. So all three of those are cases where you have a dynamic that actually is fairly simple to explain. There's one group that has to sell very quickly for one reason or another. It could be margin calls. It could just be because they have some program, which was the case in 87, that dictates that they sell more and more the further the market drops. But for one reason or another, the market drops in a very quick and violent way because of huge liquidity demand, people who are demanding very instantaneous levels of selling. But the people on the other side, the people who would supply liquidity, are not as quick on the trigger. And so you get this asynchronous behavior where the people who sell want to sell very fast, but the people who would buy from them are just not in a hurry. And if the people who are selling don't realize that, they drop the price, nothing happens. They drop it even more, expecting supply and demand to take hold and more people to come out of the woodwork to buy. And what they don't realize is because of the time it takes for people to react, somebody who might normally be ready to buy if, say, the price were down 1 or 2%, suddenly the next time they look out there, prices are down 15%. Instead of that meaning they'll buy a whole lot, which is what would happen sort of with Economics 101, they step back because something's going on here that I don't know about. I don't want to get involved in this market until I can figure it out. And so now you get a free fall because the very act of trying to get people to buy and pushing prices down to do that actually scares people away.
It's at points in time you can just have this overwhelming surge of selling versus buying, and it's just the market can't right itself quickly enough. And certainly the flash crash was, at least on an intraday basis, just a tremendous downslaught of selling pressure and price movements. Was it a regulatory issue? Was it a market structure issue? There was a lot going on at the time. The Greek crisis was kind of unfolding. There was a lot of just scars still from the financial crisis. But of course, you had some stocks trading at a penny, some stocks trading at $100,000 as a result of this. Was this a market design or internal market structure issue, or is it a liquidity issue, or is it some combination?
Well, it starts as a liquidity issue. And then there are technical issues with the way programs for buying and selling in sort of the very quick moving part of the market where things are done on a programmatic basis. So some of these prices that you saw down to 1 penny or up to $100,000 really could be chalked up in a way to programming errors. Those were not real prices. If somebody was stupid enough to buy at 100,000 or to sell at a penny, I guess they could have. But in a way, those were artifacts of the nature of how high-frequency trading was being done. But ultimately, any of these sorts of liquidity-driven crises, you finally can trace it back to some sort of a regulatory lapse. That is, the market in some way has gotten ahead of the ability to regulate it because you can't anticipate everything that might happen. So then an event occurs, then the regulators figure out what was going on, put on additional regulations or change the market structure. Hopefully they do it. And then it's one less thing that can go wrong next time around. I think with 2020, the Federal Reserve really worked with just breathtaking aggressiveness to stem a major, probably the worst liquidity crisis we would have experienced. And so we didn't learn the lessons from that we might have otherwise learned. But there too, it's an issue of the markets having a demand for liquidity that can't be sated at the speed people want to. And the flash crash was like a minimal issue. It really shouldn't have affected anybody in a notable way because it occurred so quickly. 1987, the market crash then really persisted in its effect for months, but the actual event occurred over the course of a day. Maybe you could argue the next day there's some reverberations. So those were shorter term. But the thing with 2020 is one of the days the U.S. Treasury market traded $250 million, $250 million. It's the most liquid market in the world, and basically it was all but shut down. That was a case where we really were close to hitting the foundations of the financial system. And the Fed stepped in as not the lender of last resort, but the liquidity provider of last resort and kept things afloat.
Well, we've got, of course, a history of risk off in markets, and maybe we could target four of them: 87, let's say 98 with long term, 2008, and then 2020. Those would seem to be four very big ones, very prominent ones. And there's a bunch of mini ones like the flash crash or China in 2015, the sovereign debt crisis in 2011. So those big four are kind of conveniently about 11 years apart. But if you look at them in succession, and I'd love for you to walk us through your thinking on this, but in succession, the intervention by the Fed is ever greater. 87 was the old statement of we stand ready to provide liquidity to the markets, and they made sure that lending was happening in the system. That was about it. Of course, they eased interest rates. 98, they broker kind of a sale of long-term capital by having the counterparties pony up money. 2008 was an entirely different alphabet soup of rescue facilities. And then 2020 made 2008 almost look small by some measures. You've written about this concept. I'd love for you to walk us through ergodicity in sort of physics and the sciences versus markets, and perhaps explain that through the lens of this intervention by the central banks and what that means for the system of markets and market participants.
So the concept, which is, as you said, sort of a physics mathematical concept of ergodicity, says that you have a stochastic process that is the same now as it will be in 10,000 years. So if you look at whatever the process is, it can be for the way planets circle or the way that molecules vibrate. If you were transported in time 10,000 years from now, you would be drawing from the same sort of distribution because it's basically a mechanistic or physical system. And risk management, we could talk more broadly about markets and how people treat markets, but certainly for risk management, there's this assumption that people may not even realize they're making, that the markets are ergodic. That is, I can look at the last few years, see how the risk of the market looked, and use that to get a sense of risk going forward. But everybody says past results are not reflective of future performance. So they understand that you don't have this ergodic process with returns, but nobody seems to say past risk is not representative of forward or future risk. But you know that's going to be the case. For example, in each event that you mentioned, the market post that event was different than it was before that event for two reasons. One is the market's changed, in part because of regulation, in part because new instruments came about to try to buttress people against that similar event, and also because people learn from experience. So we're not going to have another 2008. We may have really bad things happen, but it's not going to be that again. So we have to realize that as we look at risk in the markets, and especially when I talk about risk, I'm not talking about sort of the day-to-day ups and downs, but risks are really material that are like the risks you mentioned. It's going to be different the next time around. It may have to do with credit, it may have to do with common issues, but it's going to hit us in different ways and probably hit us with innovations in the market that didn't even exist the last time around. If we look at 1987, it was portfolio insurance that hadn't existed until a year or two before. If we look at LTCM, there were these convergence trades and the ability to put on super high leverage. If you look at '08, obviously we had the whole alphabet soup of CDOs and everything else and the play of rating agencies on that basis. So the world changes. The markets are not ergodic. People are not ergodic. We learn, we change with experience, we change as we move to different points in our lives.
It's so interesting to look at periods that tend to precede big crisis events. Certainly the period before the global financial crisis was one of accident-free finance. No defaults, no volatility. It was just a giant carry trade. And I know you've also done some writing, of course, a lot of analysis of that, but you also did some writing on the 2017 period, this incredibly low vol period that presaged the blow up of the VIX ETF complex. So You talk a lot about reflexivity in markets and this George Soros concept of the sort of interaction of beliefs and the observation of prices and then kind of like that feeding back into the system. How do you see that these days? What is in play in terms of the reflexive components of markets, and are there risks out there as a result?
Yeah, I can go through the risks I see, but let me first mention reflexivity and George Soros. The concept of reflexivity, in a way, is simple to explain, but very profound. And in fact, most things that are profound can be explained in a simple way, but simply are not being put in practice. The idea that we are not only in the market, but we are the market. And that when we see things and take action based on it, that itself changes the market, which in turn changes us. It's like it's self-evident. But economics doesn't treat it that way. They think the markets are sort of out there, they're mechanistic, they're ergodic. So this is one of the things I point out in my book, The End of Theory, that because people are involved and because people act and change the environment, and you get this reflexivity, we have a different world. And I actually think it's kind of funny in a way that we have this man who obviously has taken this philosophy and made billions of dollars and actually has a strong philosophical bent, and he's ignored by economists. And he's the guy who's done more to actually prove a theory than anybody else has. But anyway, that's kind of an aside that I do go through a little bit in my book. But in terms of the market right now, I don't like to be in the situation of trying to say buy or sell, but I can, and that's my job, my career has been, is the market vulnerable right now or is it not vulnerable right now? And when you look at risk, there's really two components of risk. One is the market vulnerable? So if something happens, you could see an avalanche occur. And then is something likely to happen? The first is something that's easier to get a handle on, because often what is going to happen, because it's a risk, you just don't know. But in terms of vulnerability, the market, there's a lot of signposts out there that would tell us we have a vulnerable market. Leverage is at one of the highest points it's been historically. If you look at margin debt and free cash flow, it's the highest it's been. Concentration in the equity markets is among the highest levels it's been. If you look at the percent of the S&P 500, I've just picked the top 10 stocks. It's about 25% of the value of the S&P 500 is held in the top 10 stocks. If you look at fundamentals, so those two things, leverage and concentration, are kind of technical issues. Those things can push the market into these types of leverage liquidity crises that we're talking about. If there's a lot of leverage, a spark starts a fire because people are forced to sell if there's enough of a downdraft in prices. And if they're all concentrated, they're all trying to go through the same door at the same time. And so you get a liquidity problem. So that's kind of the technical setup for a liquidity event. Then if you go to fundamentals, we have price earnings, price to sales. A number of these valuation measures are at or near record levels. And by the way, if they're not above record levels, the only time where it's been higher is during the irrational exuberance period in late 1990s and early 2000s. And you don't want to be in that world. And from a fundamental standpoint, we have something that's similar to what we had 20 some odd years ago. So those two areas suggest really high potential vulnerability. Whether that leads to a bubble bursting or a 2000 type of event or not is something that remains to be seen. But the other thing too is when you see these periods of exuberance, you also see strange types of innovations occur. And what we're seeing now between SPACs and NFTs, non-fungible tokens, which are not part of the market proper, but you sort of say, oh, come on, you've got to be kidding. And cryptocurrency, in my mind, is another one of these, where they're kind of symptoms that we're getting a little over our skis.
Well, one of the things about valuation is that I think when we live in these very high valuation periods for long enough, we just take it as a given. It reminds me a little bit, in a different way, but a little bit of us staring at the big banks in '05 and '06 and saying, well, they're 35 times levered. And you kind of do the math and say, well, that's a 3% move to wipeout. And the CDS is trading at 20 or 25 basis points on these names anyway. And of course, 5 years later, it seems like incredible to think back on, as we were doing in 2003 for the tech bubble. And so they say never short a market on valuation, but it certainly can't help. You mentioned concentration. That's something that I think is worthy of getting your feedback on, as well, as you point to on the S&P, very high at the top, and the triple Q or the NASDAQ, it's even higher. I think the top 7 stocks get you 50% of the index. We have 4 $2 trillion stocks, all of which trade at very high PE ratios. What does it mean for passive investing? You've written some about benchmark hugging and passive investing and sort of the risks there. Walk us through your thinking on that as it applies to fragility or vulnerability.
There's a positive towards passive investing. If you have a long time frame and you're not levered, it's like you can just stand by the sidelines and watch all these accidents happen. And long term, if you're looking 15, 20, 30 years out, okay, things will kind of work their way through. And so for a pension fund, like where I worked at University of California, or for individual investors and their advisors, which is an area that I'm focused on now, they are in a world where if they take advantage of the world they're actually in, long-term horizons, no leverage, they can be passive. And you could argue that is a good strategy, but there's 2 issues to focus on with passive. One is, when you have passive investing, you basically have taken liquidity out of the market. If 80% of the market is passive, then there's only 20% of the capital in the market to be the liquidity suppliers when somebody on the other side has to get out of a triple Q position. So even though you would say there's the same capital in the market, the fact is liquidity is lower. And so if something goes wrong, there are fewer people on the other side to take action. So passive investing is kind of a negative for market structure in the face of these sorts of liquidity leverage events. The other thing about passive is to look at the benchmark that you're being passive with respect to. Ever since a capital asset pricing model in the mid-1960s came about, the basic concept has been hold the market. And hold the market means you hold more in high cap stocks. The bigger the stock, the bigger its market cap, the more you hold. Well, when you do that, you implicitly have kind of a momentum trade in place, because as a stock gets bigger and bigger and bigger, you hold more and more and more of it. And you're kind of buying into some of the buildup that creates fragility. So I've been a strong advocate of being passive in a way that isn't market cap oriented, but is more equal weighted oriented. And there's a lot of ways to do it. There's no magic approach. The problem is, if your benchmark is a standard benchmark, whether it's the S&P or anything like that, if you decide to move away from market cap in your passive investing, you're going to be having tracking error with respect to that benchmark. And at some point in time, it'll look like, even though you're actually being passive, it'll look like you have some active bet on. So those are I guess that's 3 sides of what's going on with passive.
I think what's interesting about passive is it's in this category of price agnostic buying, of which there seems to be a fair amount these days, whether it's through corporate buyback programs on the equity side, could be asset liability matching on the fixed income side. And certainly the central banks don't seem to really pay close attention to the prices that they're paying. And you can get into this situation if you were benchmarking yourself to the Qs in 2000, you were paying an 80 PE passively. So I think that's a kind of an interesting one. You talk a lot in your books about just the concept of crisis. And one of the, I would think, is a very simple but very provocative question that you pose in your closing of your second book. You simply ask, why are markets becoming more crisis prone? And so as someone who's been looking closely at risk and a lot of the complexity within the markets, over many decades now. How would you start to kind of unpack that question? What do you think is happening? Is it just a consequence of complexity that we have to deal with? Is it a regulatory failing? What are your thoughts on this big question?
That's an interesting issue that in most every sphere, we get better over time in terms of safety because we learn from our mistakes. We make things better. It's kind of strange that in a world where everything else seems to get better, risk in the markets by some measures increases. And the reason it increases is there's money to be made by creating risk. If you're trying to make money in the market, if you're trying to generate alpha, well, one way to do it is just be smarter than other people, more astute in understanding where value is. But another way to do it is to create some sort of a asymmetry where you understand a complex instrument better than the people on the other side, where you can trade more quickly than they can trade. So there's an incentive to create instruments that either allow you to lever more highly without it looking like you're levering, create complexities where you can take advantage of that complexity where other people can't, or do things where you can basically transact in a way that's faster than other people can transact. And all of those things create more complexity in the market. And the more complex anything is, the more prone it can be to failure. And if you add on to that, that you can have sort of gaming. You can have people who are doing predatory types of trades and so on. What we saw with GameStop and others is kind of an extreme case of deliberately pushing people out of short positions. So I think it's the nature of the market, absent regulation, to stem this sort of natural profit-related behavior. It's natural for the markets to become more complex, to become more highly leveraged and what's called tightly coupled, which means when an event occurs, the dominoes fall before you can get your hand in there to stop them from falling. So that's sort of the nature, I think, an inherent component of the markets.
Well, I found your explanation of this concept of tight coupling to be really interesting. And certainly it feels like it does apply to aspects of our markets, or certainly periods that we found ourselves in crisis, and the systemic failure of banks and the kind of daisy chain of counterparty risk would seem to be a prominent case from 2008. In terms of the regulatory response, you spent some time at both the SEC and the Treasury. When we have these episodes of crisis, it's a very interesting and difficult, almost impossible question for the regulators or, let's say, monetary policymakers to answer, which is, at what point do you have to step in? They're there for a reason. You do create some learned behavior by jumping in too quickly, but there does seem to be a sense that, let's say from the Fed, and perhaps these are scars from 2008, that price doesn't cure itself, that the cure for low prices isn't low prices, or the cure for high prices isn't high prices, that this tight coupling was just going to feed on itself, and there's just no end to, let's say, a de-risking process. How do you think about that? Do you share that view that the system just absolutely requires a backstop at different points in time, or has the Fed become too interventionist in terms of jumping in to protect folks that are on the wrong side of losing trades?
Finally, the market will get back to equilibrium. It's a question of how much is laid to waste before it does that, and whether there's casualties that are sort of innocent bystanders who get sucked into whatever's going on. So when you get a leveraged liquidity crisis, it's like this conflagration. It's the market drops, and because it dropped, people are forced to sell. When they sell in a market that's already dropped and therefore is weakened, the market drops even more. Because the market's dropped so fast, the people who might otherwise be there to take the other side of the trade go to the sidelines, which means the people who needed to sell can't sell anymore in that market. It's not really working, so they have to turn to something else that they're owning. So now you get contagion to other markets. It's this chain of events that can lead some markets to drop. We've seen major markets. In 2008, the S&P was down, I think, 55% or so, but some subsets of the market banks were down 75%. In 2000, the internet stocks were down 75% too. So you can get like ridiculous price disruptions. And the reason it's happening is because what I was saying before, it's prices probably do have to drop. If you have PE ratios over 30 times, yeah, prices do have to drop at some point, because unless we're in a different world, that's like a little crazy. But the question is, how fast does it drop, and what's the collateral damage that occurs? So in 2008, the whole issue was the question of moral hazard and banks being too big to fail. Some people were asleep at the switch, I think, in the course of the build-up to 2008. But the problem there was you're talking about the central nervous system of the markets. And if the banks failed and the credit creation process was really hampered, it could have really long, broad-scale effects. So the Fed had to step in. The Treasury had to step in. Again, March of 2020, if the Fed hadn't stepped in, a number of markets would have failed. You simply would not have been able to sell. And that would have been a disaster, and especially when it was the Treasury market, which is kind of the core, is the keystone of the markets. When I think about some of these cases, one of the things that we missed in 2020, because the Fed did act so quickly and so aggressively, were some huge weaknesses in the ETF markets, where there were dislocations that could have really propagated problems, but they were stemmed very quickly by the Fed. So there were cracks and there were weaknesses there that got basically patched up before most people were even aware of the problem. And we had so many other things on our plate that nobody was bothering to do a analysis of what happened. Maybe somebody will at some point, but up to now, I don't think there's been much written about it.
As you outline, vol events are about essentially the market confronting that its assumptions were off base in some ways. Maybe that's in housing, could be in the value of cryptocurrencies, could be a number of things where the world changes suddenly. And then in terms of how much that's going to move the asset price, it's like, again, as you said, how quickly can you get through the exit door? And then some of that really is a function of sizing going in. And the sizing going in is always linked to some measure of volatility or expected loss, some VAR framework. And a lot of these big events seem to be somehow underestimating the tails. You mentioned studying under Robert Merton, obviously a brilliant academic and Nobel Prize winner, and of course at LTCM during its meltdown. What is it about the modeling of derivatives that we might be missing? Are we somehow just not fully appreciating just how violent these moves can potentially become? What are your thoughts, just as someone who's been inside these risk events from a modeling standpoint as well? Is there some deficiency there on the modeling side?
I think there's a huge deficiency. And it all starts with the idea that we think the past risk is representative of the future risk. Just about any risk system that's out there takes risk over the last, pick a number. If you're in short-term options, it might just be 20 days. If you're in risk management, it might be the last 1 or 2 years. You calculate the standard deviation of returns over that period, and that's your risk. And that's sort of a self-fulfilling thing. If you're in a low-risk period, in the past, you say, hey, I'm in a low-risk period. People lever on that basis. They borrow more. They become more aggressive. But there's no manifestation of that increased risk until some triggering event occurs. What people don't seem to do, and it just seems to me fairly self-evident, is look at the market environment today. Don't just look at what's been happening over the last months or years, but where are we right now in terms of the market's environment? Is leverage unusually high? Is there a sense of fundamentals being off course? Is concentration too high? Is liquidity too low? If I'm in a period right now and I say, oh, all those things that I just mentioned are true, and by the way, we haven't seen some event to allow them to be manifest, then I would be considering us to be in a high volatility environment when I'm looking at forward volatility, even if right as it stands now, market prices are not behaving that way. And by the way, you can use any statistical method you want. So you can use GARCH processes. I don't care what you use. If you're applying it to history, you're just going to get it wrong. Maybe by luck you'll have it right, but the future doesn't need to look like the past. So I feel like if we want to get risk modeling right, step one is go beyond looking at history. Step two is take the current market environment into account. And then the next thing, which people kind of do, but I don't think they totally get there, is posit possible scenarios that could be adverse to the market and recognize that something might happen. So you get into the event component of this that hasn't happened before. Right now, some sort of a break in the FANG run-up would be a scenario to think about, and how might that propagate. High inflation might be another one to think about, and what areas of the market might be hit by that. But I'm doing work, I have been doing work for a while to try to add these components in, but there's a lot of inertia because a lot of the risk systems that are out there have maintained this approach of just looking at history as the basis for risk measurement for decades now, since the mid-1990s.
Well, the 2020 crisis was such a sudden stop. And so for sure, you're going to have just massive movements in asset prices, even more so than the GFC. But I think one of your points seems really valuable to consider in light of really the treasury market malfunction of 2020, which is the work done through Volcker, and I know you've done some work on this, and the way in which risk became intermediated in the post-GFC period. The holders of treasuries were more relative value hedge funds. They had this basis trade on, cheapest to deliver type trades on. And that market just got so gigantic over time. So back to this ergodicity question, the history of accidents actually matters in terms of what creates the next accident.
As a thing with the Volcker Rule, that's a great case in point for this, that liquidity post-Volcker Rule is just different structurally than it was pre-Volcker Rule, because the broker-dealers before Volcker had real profits on the line if they didn't make markets, because they could make money through facilitating liquidity for clients. Post-Volcker, they can't do that anymore. So they may make markets as a courtesy, but if anything looks bad, they'll just walk to the sideline because they have nothing to lose. So ironically, the Volcker Rule, although I think it was important and I was really one of the people to help develop it, did have the well-known side effect of actually lowering liquidity in the fixed income markets. And I'm sorry to have broken into your train of thought, but that's one clear example of how a crisis leads to regulatory changes, but those changes themselves can have adverse side effects.
Well, it's so interesting. And of course, you were so close to the 87 crash, but I've done some studying of that and do some teaching around it as well. And to me, one of the really interesting things was the sell-off in treasuries in the preceding couple of months before the stock market crash. So inflation was on the rise. CPI went from kind of 2 to 4.5% year over year. And you started to see the bond market back up, so much so that the 10-year note got to near a 10% yield. I mean, incredible to be able to swap out of your equity market into a treasury bond for 10%. Imagine that these days. That's not on offer. And so this is part of really what's been a 40-ish year, with some fits and starts along the way, but 40-ish year bull market in bonds. And we haven't gone negative yet in the US, but other countries have. What's your take on negative interest rates, not just on the policy side where the ECB has got a deposit rate below zero, but also 10-year interest rates in Germany and other countries trading below zero? How has the observation of that impacted your own framework for thinking about market clearing prices?
I mean, the low interest rate environment, whether it's negative or marginally positive, one thing for sure is it leads to a reach for yield. And the whole treasury market and the 40-year huge bull run that we've had in treasuries, to me, I look at it in much broader or longer term context. When I was young, my parents bought a house in the early 1950s, had a mortgage of 3%. And in the 70s and 80s and so on, I thought, oh my gosh, how's that even possible? The notion of a 3% mortgage for anybody sitting in the early 1980s was like from a different world. And when I was at Morgan Stanley in 1986, one of the bond traders did a print at when the bond hit 8%. From being way higher, came down to 8%. And he wanted to memorialize the point that the bond market's finally gotten back to normal, because 8% was like normal. And so now we're kind of in this world where if you pose to anybody the notion that you could have interest rates of 7 or 8% for treasuries, they'll look at you like you have three heads. 2 years ago, if you suggested inflation could be a risk, people would think that you were like living in the distant past. So my focus is not so much on whether rates are slightly negative or slightly positive. It's thinking of the world over a longer time frame. And I'm not saying rates will go up to 8%. I'm not saying inflation will go up to 8%. But we really are lulled into a point now that's sort of the complete opposite of where we were sitting in the 1980s. So I think we could be really shocked if inflation becomes a real thing and moves prices, affects nominal rates. I guess in a way there's a positive to that for the government because it's a silent tax. But my concern, which a lot of people do think I'm a little, well, actually, people don't think it's crazy now the way they did a few years ago. But certainly a few years ago, the concept of inflation being an issue was not even in people's minds.
Yeah, it's almost like the next crisis to occur is the one that happened longest ago. And it's just impossible for people to surmise a bout of inflation that's sustained because no one's really lived through it. It's just so long ago.
That's right. The last time was in the 70s. I don't know if you're around there. I was. Gerald Ford had the whip inflation now, but
that's right.
It's like 74 or so. So the thing about risk management is you almost always are wrong. It's kind of, if you have a sort of batting average in trading, that risk manager who's really thinking, I think the way a risk manager should think, you wouldn't be around much because you have to look at out of the box risks. And the risks that matter are the ones that people are not really fully thinking about or they can't calibrate. Like there's some risks we can calibrate because they happen over and over and over again. We just know they're part of the market and they're in the front of everybody's face. They go into every calculation that you're making. The risks that are of concern are the ones that people simply aren't thinking about. And a lot of those risks just won't be realized. So when I think about inflation as a risk or a secular rise in interest rates as a risk, I'm not making a trade based on that, but to not think through what parts of the market would be affected and how that might cascade, then you're not really quite doing your job if you're in the risk area.
In terms of your current thinking on where some of these risks might lie, you had alluded to SPACs and NFTs. Be great for you to share a little bit more of what's on your mind and what your concerns are in those segments of the market.
I actually wrote a few things on LinkedIn on SPACs and on NFTs and on crypto actually in the last little while. SPACs are kind of, in my mind, sort of a canary in the coal mine type of a thing. They're not going to destroy the market, but they're the type of innovation that comes around when the markets are pretty frothy. The thing that's interesting about SPACs is the investors tend not to make money in them. The sponsors can get like 25%, and that comes out of the investors' pockets. And so there's a whole lot of things with SPACs to think about, but they now, in number and in proceeds, exceed over the last year or so traditional IPOs. The thing about NFTs and crypto is kind of the same. These things are not going to be the leading edge to lead to a market crisis, but that they are there with people having such fervor is kind of symptomatic of a strange time in the market. And you see this, other times where things get really frothy or extreme. Here's the thing about crypto. There's a lot of things that can be said, but no central bank is going to cede control of their monetary authority. If crypto becomes a thing in any real sense, it's going to be prohibited because the central banks are just not going to allow it as an alternative to their currency. And they can prohibit it. They just say, hey, credit card companies, hey, treasury, hey, mortgages, every Starbucks, you cannot accept payment in terms of crypto. And maybe you can then use it to pay your babysitter, but that's pretty much it. So to me, you can make a lot of arguments in a lot of different ways about crypto, but to me, that is kind of the most out there. NFTs, again, maybe they end up going someplace, maybe they don't, but I think seeing the types of sales that we've observed recently is a little like, what world are we in? So when I look at SPACs or crypto or NFTs, I don't care about them as a risk in and of themselves, but I look at them as sort of some of the symptoms that suggest we're in a vulnerable period.
When I look at that space, the crypto space, and I certainly don't know a ton about it, but I follow Bitcoin pretty closely, mostly not for its ultimate adoption potential in terms of payments, but really as a digital gold. What I'm most interested in is thinking about it really from an optionality standpoint. It has got, at least potentially, a far right tail. Part of portfolio construction, of course, is finding good assets, but it's also putting together a portfolio that's got some correlation properties that can be defensive. Those are increasingly difficult to find. I would say even for the stock bond correlation, which has been such an underpinning of portfolio construction for so long, that one is less obvious than it was. That kind of risk on, risk off characteristic of the bond market hasn't been as much recently. So I think that's pretty interesting.
But what's not clear, if you calculate the beta of Bitcoin, it's 1. So the notion that it's contra equities right now is not borne out by its empirical characteristics, but then again, we have almost no history to go on. So at this point, the idea that it's a hedge of some sort is not evident. But the problem is also there's no fundamental basis or theoretical, I hate to use the word theoretical, but strong narrative arguments on why it should be, except that if everybody agrees that if things go bad, they're all going to buy Bitcoin, then you could sort of say, yeah, we all voted, and we've all voted to have this thing where we'll buy it if inflation is high. But there's no mechanism there. And the idea, it's an alternative to fiat currency, and there's a lot of different views. This is just my particular view, and there'll be 10 other people with different ones, but it's not really an alternative to fiat currency because it's not a currency. It won't be usable as a currency if fiat currencies are under threat because it'll be prohibited. It's clearly not a store of value by any measure. So I really am sort of in the, I don't know what in the world is going on here camp with crypto. But then again, there's a lot of super intelligent professionals out there who have the opposing view, and we'll just see how it plays out.
There is a remarkable amount of brain power going into the asset class, well beyond what I look after. And I think back to your point on there's no fundamental value that we can derive. Totally the truth. It's valuable because we say it's valuable. It's a psychological thing, and that may or may not hold. You really are, just as you said, you're relying on this notion that, if things start to get dicey or confusing, perhaps this is the sort of thing that people gravitate towards. It really becomes more of a psychological asset than anything else.
To your point, there are people out there, this is not just a flash in the pan of a bunch of millennials who think something's fun. There are people going into it, although a lot of financial institutions' reason for existence is to go wherever they smell money. And there's now money to be had in the crypto space, so that some big firms set up market-making operations or things like that. It's kind of like, fine, guys, if you're going to go into it, we're there. We're agnostic, but if there's money to be made, we're there. So I kind of handicap some of what we observe with large institutions who are moving into the space, because they'll move into whatever space seems to be occupied by people who have money in their wallet. Maybe that's a little cynical, but I think that's kind of what their job is.
Well, let's finish our call with some of what you're up to now. You've founded a firm, Fabric RQ. Tell us about your venture, your constituency in terms of client base, and what you're hoping to accomplish.
I've been in charge of risk management at broker-dealers and hedge funds, then in government, then at a large pension at UC. The thing that I noticed when I was at Treasury was that a group that's really been underserved, but it's really at the foundation of finance and the markets, are the asset owners. So people like us, and people like us through our pensions, and then people like us who are operating through advisors or wealth managers. And the wealth management community has been really underserved. They just have not had strong risk management available to them, certainly not at institutional grade. So when I was at University of California, I started developing methods there that could be applied to pensions and to wealth managers, and started this company, Fabric RQ, we also just call Fabric Risk, to develop software for wealth managers, financial advisors, and so on, that allow them to have the same level of risk management capability for their clients that big institutions have. And we actually just started a couple of years ago. We have a product that will be hitting the market in a couple months. So my interest really in moving into the asset owner space, and the reason I even went to the University of California, is that it's not just that that group has not been well served in terms of risk. It's that if they are well served, they can provide buttress against a lot of the risks in the market. We talked about the need for liquidity supply and the need to sort of reduce huge liquidity demand. That's kind of the center of a lot of crises. If you can get a substantial amount of capital to, first of all, not contribute to a downdraft, but even better yet, be available to provide liquidity in the course of that, you really dampen a lot of the crises that might occur. And the group that's naturally there to do that are the asset owners, whether it's individuals or pensions, because they have a long time frame. They can't be forced out of the market, but they need to understand what's going on before they can make good decisions there. If they have the right information, they can make really good decisions when banks and broker-dealers and hedge funds are totally like running for cover.
That's excellent, and certainly a part of the ecosystem of finance that does need very sound advice. Certainly getting to retirement is difficult enough, but in a world where interest rates are low and look like they're going to stay that way for a long time and real rates are negative, makes it all the more difficult. So getting sound advice is critical.
Yeah, and to reach the whole issue on the other side, that because of that, it's easy to feel like you have to take risks that maybe you don't recognize even the level of those risks that you're taking.
Rick, wonderful conversation. Really appreciate you being a guest and sharing your insights with us today.
Well, happy to be able to come on it.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.